Welcome back. Look, if you've been peering at your investment portfolio through your fingers this week,
Oh, yeah.
desperately pretending the red numbers aren't actually there, trust me, you are not alone.
Definitely not.
I checked mine this morning, and I briefly considered liquidating absolutely everything and just moving to a cabin in the woods.
It's tempting.
Because as of today, March 9, 2026, the Nifty 50 has dropped more than 10% from its January peak of 26,373.
Right.
We are officially in correction territory. We are hitting the lowest levels we've seen since April of last year.
Yep.
So take a deep breath, drop your shoulders. We are doing a deep dive today to make sense of this exact situation so you don't make any panic-driven decisions.
That instinct to, run for the hills, it's completely natural when the screen is bleeding red. But making long-term financial decisions based on short-term adrenaline is rarely a winning strategy.
Right, exactly.
You need context. You really need to look under the hood of the market to see what the smart money is actually doing.
And context is exactly what we're bringing you today. To figure out what's really happening, we're unpacking a massive stack of diverse sources. We've pulled raw, unfiltered market data from NSE India and Trendline.
Which is crucial.
Yeah. We've got the latest technical forecasts from Anand Rathi and Axis Direct. We're even tracking real-time retail investor sentiment from the investing.com forums.
The forums are wild right now.
They really are. And we are pairing all of that with fundamental macro analysis from Equity Master and Mint.
It's a really important mix of data. Because if you only look at the macro news, you'll be terrified.
Oh, absolutely.
And if you only look at the charts, you'll just be confused. We are layering the data here, macro, micro, sentiment, and technicals, to give you a true 360-degree view.
Our mission for this deep dive is simple. We want to help you cut through the absolute panic out there, understand exactly the mechanics of why the broader market is bleeding, look at what the big institutional money is actually doing behind the scenes, and
find the opportunities.
Right. Uncover where the hidden opportunities are currently hiding in plain sight. Okay, let's unpack this. Let's start with the big picture.
Sure.
The market isn't falling because Indian fundamentals suddenly broke overnight. Our GDP didn't suddenly evaporate. This is about global fears, specifically geopolitical triggers.
If we connect this to the bigger picture, we have to look at the escalating tensions in the Middle East, specifically involving the U.S., Israel, and Iran.
Right.
And before we go any further, I want to be absolutely clear for you listening. We are looking at this strictly through an economic and market lens.
Yes, purely economics.
We aren't taking any political sides. We aren't analyzing the geopolitical rights and wrongs, and we definitely aren't making moral judgments. We are purely tracing the economic fallout of these events on your portfolio.
Because the market doesn't have political opinions. It only cares about risk, predictability, and supply chains. And the supply chain at risk here is arguably the most important one on the planet.
It really is. The conflict is directly threatening the Strait of Hormuz. For anyone unfamiliar, that is a narrow choke point between the Persian Gulf and the Gulf of Oman. A massive percentage of the world's oil flows through that specific strait.
It's a massive bottleneck.
Exactly. Any threat to that route causes immediate, visceral panic in global energy markets. Because of this localized escalation, we've seen Brent crude oil spike dramatically, pushing toward $120 per barrel.
Wow.
To put that in perspective for our listeners, we haven't seen oil consistently sustain those levels since the shocks of 2022.
And this is where the global story hits home for India specifically. We are the world's third largest oil importer. We run our entire domestic economy on imported energy.
That's the transmission mechanism for the pain. When oil hits $120 a barrel, India effectively imports inflation.
Let's break down how that actually works for a second. It's not just about petrol getting more expensive at the pump.
No, not at all.
Every single good that moves on a truck, every factory that uses power, every logistics network suddenly faces aggressively higher costs.
Right. And this massive oil bill immediately strains the country's current account deficit. Think of the current account deficit like a national checkbook. It measures the balance of trade.
Okay.
When the cost of what we buy from the world, mostly oil, massively exceeds the value of what we sell to the world, that checkbook bleeds. And the immediate victim of that strain is always the currency.
The data on this is incredibly stark. According to Mint's macro analysis, the Indian rupee has just hit a record low of 92.3 rupees to a single US dollar.
It's brutal.
It creates a vicious cycle. Oil gets more expensive globally in dollars, and our domestic currency simultaneously weakens, meaning it buys even less of that more expensive oil.
It's a classic macroeconomic double whammy. And you
Hmm.
can see the ripple effects of this clearly when you look away from the broader Nifty and look at specific sectors.
Like the banks.
Yes, take the Bank Nifty index. It is suffering significantly worse than the broader market right now. It's dropped over 2,700 points in just a single week. It's hovering precariously around the 57,780 mark.
I want to pause on that because it's a critical point. Why are the banks taking such a disproportionate beating? A geopolitical conflict in the Middle East doesn't immediately change how a bank in Mumbai operates its local branches.
Right, it seems disconnected, but it traces back to that imported inflation we just talked about.
Okay.
When inflation starts rising rapidly due to high oil prices, the Reserve Bank of India, the RBI, has a mandate to step in and control it. Their primary weapon for fighting inflation is interest rates.
Which everyone was hoping would drop.
Exactly. The market had been hoping and pricing in that the RBI might start cutting interest rates soon to spur growth. But with oil at $120, those rate cuts are completely off the table.
Gone.
Borrowing costs are going to stay elevated for much longer. When borrowing costs stay high, credit growth restricts because companies don't want to take out expensive loans to build new factories.
So that squeezes corporate margins across the board.
Yep. And ultimately, it punishes the banking stocks because their loan growth slows down and their cost of funds remains really high.
The mechanics of that make total logical sense. Geopolitics disrupts oil. Oil spikes, inflation rises, the rupee drops, rate cuts are delayed, and the banks bleed.
That's the chain reaction.
But logic often goes completely out the window when people see their life savings drop. I was scrolling through the retail trader forums on investing.com this morning, and the panic is palpable.
Lots of doom scrolling, I imagine.
So much doom scrolling. People are posting things like, economy katre main high K, literally asking if the entire economy is in danger. You've got amateur traders confidently predicting the Bank Nifty is going to crash all the way down to 55,000 by next week.
The fear is definitely real. And we can actually measure the psychology of the market right now. The India VIX, which analysts commonly refer to as the fear gauge, has surged over 150% so far in 2026.
Wow, 150%.
Yeah. That tells us that retail investors aren't just anxious. They are actively paying massive premiums to hedge their portfolios against further disaster.
But feelings aren't facts, and foreign panic doesn't equal institutional strategy. I want to bring in some actual trading data from the National Stock Exchange, the NSE, specifically looking at the trading session from March 6th.
Let's hear it.
I was looking at this data, and it's a massive contradiction. Foreign money dumped over 6,000 crores in a single day, but domestic money actually outbought them at nearly 7,000 crores. Is domestic retail money really strong enough to act as a permanent shock absorber, or are we just delaying the inevitable crash?
It's actually more than a contradiction. It represents a historical structural shift in the Indian market. Let's look at the foreign institutional investors, the FIIs. They are undeniably fleeing.
Big time.
On March 6 alone, FIIs sold a net of over 6,000 crore rupees. When global panic hits, these massive foreign funds pull their capital out of emerging markets like India and rush toward traditional safe havens. They park their cash in gold or U.S. treasuries or just the U.S. dollar itself.
Over 6,000 crores fleeing in one day is a staggering outflow. In previous decades, that would have triggered a total market circuit breaker.
Oh, it would have cratered the index completely. But that is only half the story today. On that exact same day, domestic institutional investors, the DIIs, stepped up and bought a net of nearly 7,000 crore rupees.
Incredible.
They completely swallowed the foreign selling pressure.
So they aren't just holding the line, they are actively absorbing the panic.
Precisely. And this is a crucial takeaway for you listening right now. We have to understand where that domestic money is coming from. It's largely driven by SEP's systematic investment plans.
Right.
For our international listeners, SEPs are automated monthly investments into mutual funds. Millions of middle-class Indians have automated a portion of their salary to buy the market every single month, regardless of what the news cycle says.
It just happens in the background.
Yes, this isn't just a pool of capital. It's an automated behavioral wall of money. It is acting as a massive structural shock absorber, preventing the kind of total market collapses we used to see during global crises.
So what does this all mean? The headline question everybody's asking, and the one Equity Master posed in their latest fundamental analysis, is the big, scary one. Is the Nifty headed all the way down to 22,000?
Equity Master laid out a very rational, probability-based scenario plan based on the duration of this geopolitical crisis. They aren't predicting the future, They are mapping out the possibilities based purely on the duration of the oil shock.
I think we need to walk through those scenarios so our listener knows what guideposts to watch for over the next few weeks.
Let's do it. Scenario 1 is the optimistic view. If the geopolitical tensions cool down relatively quickly, diplomacy steps in, and crude drops back below $95 a barrel. In that environment, Equity Master projects the Nifty will rapidly bounce back to the 24,500 to 26,500 range.
Okay, that's the best case.
Scenario 2 is the prolonged tension view. If things remain tense, no resolution is found, and crude stays sticky between $100 and $110. In that case, the index likely hovers, chops around, and consolidates in the 23,500 to 25,000 range as the market adjusts to a higher cost reality.
And the worst case scenario, the one that has everyone on the forums terrified.
Scenario 3 is a prolonged, drawn-out Middle East war that physically disrupts supply and keeps energy markets in a sustained state of panic. In that specific environment, a drop to 22,000 on the Nifty is absolutely on the table.
So it's an if-then calculation, heavily dependent on the price of a barrel of crude. Let's look at the immediate technical levels right now.
Yeah, let's look at the charts.
Based on the data from Trendline and Anand, the Nifty is currently trading in that 24,000 to 24,450 zone. And honestly, the momentum looks undeniably ugly on paper.
Very ugly.
The Nifty has broken below 8 out of 8 of its simple moving averages. For anyone new to technicals, when a stock or an index is trading below its short, medium, and long-term averages simultaneously, that is a picture of pure, aggressive downward momentum.
The short-term trend is definitively bearish. There is no sugarcoating that. Furthermore, the RSI, the Relative Strength Index, is currently sitting around 33.5.
Which means it's fast approach at.
Oversold territory.
Right. I always think of the RSI like a rubber band. You can stretch it down pretty far, but eventually the tension gets so tight that it has to snap back even if just temporarily.
That's a perfect analogy. The RSI measures the speed and magnitude of recent price changes. When it dips toward 30, it suggests the selling has been so intense, so rapid, and so unrelenting that sellers are becoming exhausted.
They've run out of shares to sell.
Exactly. A short-term bounce or relief rally becomes highly probable simply because everyone who wanted to panic sell has already done so.
Which brings us to a really interesting glimmer of hope hidden in the charts from the technical analysts at Axis Direct. They were analyzing the Nifty weekly chart, and they noted the formation of something called a long-legged spitting top.
Yeah.
Now, break that jargon down for us visually. What does a long-legged spinning top actually mean for the psychology of the market?
Think of a candlestick chart as a visual representation of a tug-of-war between buyers and sellers. A spinning top candlestick has a very small, real body. That means the opening price on Monday and the closing price on Friday were almost identical.
Okay.
But it has very long legs or shadows on the top and bottom. That means during the week, prices swung wildly high as buyers pushed and wildly low as sellers panicked.
It's a picture of extreme volatility ending in a stalemate, pure market indecision.
Extreme indecision. But in technical analysis, location is everything. This specific pattern is appearing right at a crucial long-term support zone, specifically the 24,000 to 24,300 level.
Oh, that's key.
When you see extreme indecision and a stalemate right at a major historical support level, it often signals that the massive downward momentum is finally stalling.
The bears are tired.
Exactly. The bears are throwing everything they have at the market, but they can't break the floor. Axis Direct points out that despite the recent bloodbath and the scary headlines, the long-term bullish rising channel for the Nifty, the massive trend line that has defined the market for years, is actually still completely intact.
So if the broader index is locked in this tug-of-war, we can't just buy the market blindly right now. We have to be snipers, not shotgunners. Here's where it gets really interesting. Because you don't just invest in an index, you invest in specific living, breathing companies.
Exactly.
Some sectors are getting crushed by the macro environment, while others are acting like absolute fortresses. Let's pivot to actionable insights. Based on the oil shock we just dissected, Equity Master is very clear on which sectors you need to avoid like the plague right now.
It's all about input costs.
Yeah.
Any sector heavily reliant on oil as a raw material or a primary operating expense is highly vulnerable. That means you want to avoid the aviation sector entirely because jet fuel is by far their biggest variable expense.
Makes sense.
You want to avoid the paints sector as their raw chemical materials are direct crude oil derivatives. Logistics and auto are also going to see their profit margins severely pressured by high fuel and freight costs.
But on the flip side, what are the defensive shields? If institutional money is still in the market, where are they hiding it? Let's go a layer deeper on this.
Smart investors are actively rotating their capital into sectors whose earnings aren't tethered to the price of a barrel of oil. We are looking at information technology, pharmaceuticals, and fast-moving consumer goods, FMCG.
Let's look at why that is.
Well, IT and pharma companies largely earn their revenue in U.S. dollars. Because high oil prices weaken the Indian rupee against the dollar, these companies actually see a currency benefit when they bring those dollars back home. It acts as a natural hedge.
Very smart.
And FMCG, on the other hand, offers stability because they produce everyday essentials. Even in a crisis, people still buy toothpaste and soap.
True.
These companies have the pricing power to pass minor inflationary costs onto the consumer without destroying demand.
That makes a ton of sense. And even in a bleeding market, there are specific pockets of incredible individual strength. Axis Direct highlighted 3 specific technical picks that prove you can still find aggressive buy signals amidst the panic, provided you look at the right charts.
Yeah, these are great examples.
Let's look at the trends. First up, Karnataka Bank, ticker KTK Bank.
Karnataka Bank is a brilliant study in relative strength. While the broader market is falling and the banking sector at large is struggling, this specific stock just broke out of a falling channel that had trapped it since early 2024. And it didn't just inch out quietly, it broke out with a massive surge in trading volume.
I love seeing volume confirm a breakout. It means institutional money is actually participating in the move, not just a few retail traders clicking buy. And Axis Direct's target on that is around 240 to 248.
Right.
The second pick is Astra Microwave, ticker Astra Micro. What is the fundamental setup telling us here?
This one is rebounding beautifully within a well-established rising channel. Despite the broader market chaos trying to pull it down, Astra Microwave managed to cross back above its 200-day moving average.
That is a major signal of long-term trend strength.
It is. Axis Direct's analysis suggests this stock has significant runway ahead, completely ignoring the downward pull of the broader market. The target they've mapped out is right around 1145 to 1180.
And that's the real lesson here. Strong individual fundamentals will eventually divorce themselves from macroeconomic panic.
Absolutely.
The final pick is in the financial space, but it's not a traditional lender. It's Aditya Birla Sun Life AMC, ticker ABSLMC.
Yes, the asset management company. This stock executed what technical analysts call a perfect cup-and-handle pattern breakout.
For those who haven't stared at a stock chart lately, imagine the literal shape of a teacup. The stock dips and recovers over several months to form the cup, then it dips slightly again to form a small handle before exploding upward.
Exactly the right visualization.
It essentially means the stock has consolidated its energy, shaken out the weak hands, and is ready to run. And for this one, the target zone is 1035 to 1070.
It's a classic bullish continuation pattern. Breaking out of a cup and handle in this specific terrible macro environment shows immense relative strength. The buyers are completely ignoring the broader index weakness.
What's fascinating to me is that you can have a headline index that looks like a horror show on the evening news, but when you look under the hood, individual stocks are completely ignoring the macro noise and triggering fresh technical buy signals.
What's fascinating here is the massive disconnect between short-term sentiment and long-term reality. The index looks terrible because foreign money is reacting algorithmically to global oil prices.
Right.
But individual stock structures are generating buy signals because the underlying businesses are still thriving. We have to remember that India's core economic fundamentals remain entirely intact.
Right. We are still looking at robust 6 to 7% annual GDP growth. We have some of the cleanest, strongest bank balance sheets we've seen in a decade. We are in the middle of a massive multi-year corporate capital expenditure cycle. None of that disappeared or got canceled just because Brent crude went up 20 bucks.
Exactly. The geopolitical noise is incredibly loud right now, and it is dominating the headlines, but the actual economic engine of India has not fundamentally stalled.
So, bringing this all together for you listening, it is completely valid to feel anxiety when you open your brokerage app and see a sea of red. But the core lesson from today's deep dive is this. Do not panic, sell fundamentally strong companies, simply because geopolitical events thousands of miles away are temporarily shaking the broader index.
Please don't.
This is not the time to hit the sell button blindly in a panic. It's the time to use the dip to reevaluate your actual fundamentals. Are you holding vulnerable, oil-dependent stocks that will suffer margin compression? Or are you holding defensive, high-growth assets that are currently on sale?
This raises an important question, and it's a thought I want you to really ponder as you look at the markets this week. We noted earlier that domestic retail investors and domestic institutional investors are currently, single-handedly, absorbing a historical dumping of shares by foreign institutions.
They are building a literal wall of capital.
They are, but think about what happens next. Geopolitical tensions, historically, always eventually cool down.
Eventually, yes.
It might take weeks, it might take months, but if and when this Middle East crisis eases, oil prices will normalize. When that happens, the trillions of dollars in foreign capital that fled to safety will inevitably try to rush back into the high-growth Indian market because they need the returns.
They always come back.
But will they find that domestic investors already own all the best assets? And if so, at what massive premium will those foreign institutional investors be forced to buy them back from you?
That is a brilliant point to end on. The panic of today might just be setting the premium price tag for tomorrow. Thank you so much for joining us on this deep dive to unpack the numbers, filter out the noise, and look at the actual data. Stay calm, stay informed, don't let the headlines dictate your strategy, and we will catch you on the next one.